Welcome back to our Washington Policy Summit. For those of you who have been with us throughout the morning, we appreciate you returning. It's been an incredible morning. We've had a great set of topics and speakers. Now we're going to shift gears a bit and focus on oil market volatility, which we've seen almost an unprecedented manner over the past month or two. We have with us today one of the leading oil experts and a good friend of mine, Robert McNally, who's president of the Rapid Energy Group. His bio is accessible under our app, which I hope that you'll go to, because that's how you can actually feed in your questions. The questions will come to me and I will pose them to Bob as the conversation evolves. Bob, thank you for being with us here today. I know you're working 20-hour days. You got clients around the world. They're all asking you, how did we get here and what comes next? And I must say, I was surprised that we saw a collapse in the previous agreement. I was sitting in London my last foreign trip before I was grounded. And given what was unfolding with respect to a global pandemic, the last thing I would have expected is a breakdown in the oil market cartel. And I don't use the word pejoratively, but an agreement in which had worked well for some period of time, leading to enormous volatility and potentially the undermining of industries, especially here in the United States. So, Bob, how did we get here in terms of volatility? Obviously, the rapid drop-off in demand because of the virus and the drop-off in economic activity is a cause on the demand side. But can you just set the scene for us, some context about what transpired before the pandemic, which led to this volatility? And then we'll focus a little bit about the agreement just announced this week.
Yeah. Tim, it's great to be with you and to see you again. You're absolutely right. You know, if you look back to the very beginning of the oil market in 1859, one thing that's almost always been the case is when you have a price collapse because of oversupply, it almost always causes producers to come together, cartels or governments to come together and manage the market and reduce supply. Sometimes these cartels go away after a few months. Sometimes they last for decades, like the Texas Railroad Commission did when it governed the oil market with the Seven Sisters from the 30s to the 70s. But what happened here in March, as you were sitting in London and so forth, I was coming back from Riyadh and the OPEC meeting, is we hit a problem that's really too big for any, let's call it, swing producer or cartel to manage. That's the essence of this. I don't think it's like Russia and Saudi Arabia woke up on March 6th and said, you know what, I've had it. This marriage is not working out for me. Let's take shale down and go our separate ways and everybody produce all they can. No, I think even Russia, which is no friend of shale, even Russia said, you know what, this demand collapse is too big for us to handle. We can handle a million barrel a day collapse or something like that, but a 20 million barrel a day collapse, too big. And so that's what really led to the breakup of this. It's a problem that's in a way too big for the cartel to resolve. And so there was a sense of everybody just go back to your corners, produce all you can. Now, the Russians were surprised at how the Saudis responded. I don't think Russia expected Saudi Arabia to say, well, if you're going to walk out on us and not even give it a college try here, we're going to go back and produce every barrel we can. And that caused the price of oil to collapse here into the teens for WTI. Now, that Mr. Putin didn't expect. And so for the second time in 5 years, Mr. Putin has had to sort of walk back to the Saudis and say, okay, we'll cooperate again. So Russia has been taught, we were taught this lesson in 2015 and 2016 as well, when they refused an offer from the Saudis to cooperate in managing the market. The price goes really low, and that hurts Russia, especially. Russia is going to have to shut in its oil production, a lot of it, no matter what, because it doesn't have the storage and the pipeline capacity and the outlets to move the crude. So we're after a month of furious, let's say, market share war and severe price drops, we're back and they're cooperating again. And that was a deal over the weekend. President Trump had to get involved. But, we still have the problem, Tim, of a demand collapse that's too big, even for this big cut of 9.7 million barrels a day to solve. You've got a demand collapse of, in this month alone, well above 20 million barrels a day. So we're well over 20% of the market. We don't have that in modern times. Our models don't have that. You're seeing in parts of Europe 85% collapse in transportation. I mean, we're just into terra incognita. and it's almost too big for the producer group to solve.
So we have an agreement. As you said, it appears the White House helped broker the deal, although I don't have any inside details. I have some questions about why they would have done it. So is this deal durable? Are we going to be back at it in 6-8 weeks from now? Is this a lasting, durable agreement?
You know, I think it is lasting and durable, if only because the producers, like especially Russia and others, they have no choice but to shut in production. I mean, the way it works is you can't bring a barrel out of the ground if you don't have somewhere to store it or somewhere to refine it. And most barrel counters, us included, think that by the end of May, we will have effectively stored all the crude we can. So then you almost have no choice but to cut. And then it becomes a virtue and a necessity. You're going to be complying and adhering to the deal. The question will come when we start to recover, when we start to see demand pick up again. And producers will be eager to start increasing production. Will they do so in a unilateral way, in a way that undermines cooperation and gets those competitive juices flowing again? But for the time being, Tim, no choice but to comply. We're going to see big shutdowns in supply because we're seeing a big shutdown in demand.
And what is your forecast for demand going forward? Is there permanent destruction in demand, or are we going to change the way in which we're working at home? Or are we going to work at home more? I haven't been in my car in a week.
Yeah.
Is there something permanent about the way in which we're going to consume oil? And so what's the magnitude of that permanent change?
You know, that's the million-dollar question. I know you've had Greg Ip and other smart macroeconomists on. I'm sure you're convening the best. I wish I had the answers because I don't know what the economy looks like exactly in 2022. I will say from a classical oil market analytical context, we would expect a boom to follow bust. Price busts like this one sow the seeds of the next boom on the demand and supply side. So right now, gasoline's below $2 a gallon in the United States. There's not much driving because we're not allowed to. But we're going to hit a sweet spot probably later this year where economic growth will return. And because of this oversupply, gasoline prices are going to be dirt cheap. That means you're probably going to see consumption go back pretty fast. And also, folks who are buying cars in the next 1 to 2 years, they're less likely to buy an electric vehicle or a more expensive vehicle than a gasoline car. So we're probably going to see, just from a consumer response to this really low oil price, a increase in consumption and a deferral of purchases of more expensive vehicles. So in a way, we're creating the seeds of a boom in consumption. That's just cyclically. On the supply side, we are going to hurt investment. And most investment, aside from shale, is a 5 to 7 year prospect. It takes a long time to bring on those Guyana offshore fields and so forth. And so you have to have their big lead times, and it's upfront capital expenditure. So when you go down into the teens here, you're going to cancel and defer a lot of investment. That means oil supply simply can't come back in 2023 or 2024, even if we really wanted to, if we're booming next year. So from a classical cyclical standpoint, I would say enjoy the bust if you're a consumer, because we're going to have a boom, and the boom will be fueled by the bust. But you raised a question, to what degree will the coronavirus permanently affect behavior and transportation patterns? Here, again, there's a chance if the economy doesn't get back to where it was for 2 or 3 years, we may not return to a 100 million barrel a day oil market. That doesn't mean we'll be tight, though. Remember, we can have a tight oil market at any level, 70 million barrels a day, 80 million barrels a day, 90 million barrels a day. In some of the discussions we've heard so far, folks say, well, you know what, we're all going to be working from home. No one's going to want to drive. Yeah, there'll be less public transportation, but oil demand is going to take 2 or 3 years to get back to 100 million barrels a day. We're going back to 2012. That's fine. That doesn't mean that oil prices are going to be low necessarily, because if supply is being curtailed by even more than that, we could be in the $100 level and still be at 10 years ago in terms of demand levels. So it's always with the price of oil, it's always a supply and demand things, and both things are going to be impacted by this coronavirus.
If you look at the supply cost curve, who are the low cost providers? Who can weather a lengthy duration of low prices? And where do the U.S. frackers fall on the supply cost curve? What price is important for them?
So if we think about pure economics of oil production, not what budget revenue they need to keep their society afloat, right? Just pure oil economics.
Right. It's a different question. Right.
Different question. On the low end, you've got your Saudi Arabia and your Russia's. Their lifting costs, what it costs them to bring a barrel of oil out of the market, is the single dollar per barrel. It's less than $10 a barrel. Now, Russia still has the problem that it has nowhere to put the oil, but it has the lowest lifting costs. Similarly, Gulf producers, these large conventional fields close to terminals in the Middle East, those are your lowest cost producers. We in the United States, if you think about our shale break-evens, they are in the order of $30 a barrel TI for the most efficient operators, and many go above that. So here at $20 WTI, we are out of the money in terms of U.S. oil production. So we are on the high end. Higher than us would be Canada, oil sands, partly because, like Russia, they're at the back of the supply chain, if you will. They're landlocked with few options to export and store. And so they have high costs. So we're sort of in the middle high end in the cost curve. At current prices, we're not sustaining our industry. Prices have to go higher. That's why even President Trump reversed himself and said he wants to see higher oil prices. And by that, I think he means probably into the 30s, not into the 20s. But the countries that can most able to produce now, your Saudi Arabias, and if they can get storage and refining, your Russians.
And so that means the Angolas and Nigerias and the Ghanas of the world are truly out of the money then. That at these prices, it's not economic for them to produce.
Yeah, that's right. I mean, they have a little bit of higher production costs, especially the offshore fields in Angola and so forth. But they also have the issue where they're dependent on mainly the Chinese market, especially Angola. I think 70, 80% of their sales. And so when those Chinese refiners start to shut down, or the Chinese refiners become very choosy about who they buy from because it's become a buyer's market to some degree, the Angolans, who were dependent on selling an enormous amount of their oil to China, they're in big trouble. So they can see their sales fall, even though their lifting economics are probably are better than ours.
I remember a few years ago, I took a drive across North Dakota, and the number of 18-wheeler trucks heading down those strips of highway taking oil field supplies was just amazing. It was it looked like a wagon train of supplies. So that's gone, right? The frackers just cap those wells and walk away. And how quickly can they reinstitute or reconstitute those fields once prices go back up?
I think pretty fast, as long as there's, let's say, above ground risk is minimal, right? The molecules are there. The technology is there. The people are there. The companies that operate those fields may have some trouble. We have some equity ownership, so title may change. But the United States is not done in terms of being a major oil producer. And assuming, again, we don't have political change where we resist through policy and regulation a return of oil production, right? You have to have a supportive above ground conditions. Assuming we're favorable toward that in the future, then I think U.S. shale will bounce back. And we weren't done becoming more efficient, figuring out how to recover more of the oil resource in place and so forth, never against, especially American oil ingenuity. So we have to have supportive above ground conditions. The other thing is capital. We got to remember, going into this coronavirus, investors were sort of tiring of the shale oil model. They had lost a lot of money. They were not cash flow positive. And we even, and many others before the coronavirus, saw shale oil growth slowing. So there was this pressure on the shale sector to get more profitable. We probably would have had some slowdown in the rate of growth of shale oil production. So there were challenges the industry was facing. But in terms of the rocks, the technology, and the ingenuity, it's all there. And when oil prices boom again, as I'm very sure they will, the United States will come back in a matter of a year or two, I think.
Bob, I've got a question about oil demand, the nature and the source of oil demand. We talked a little bit about autos, and I agree where SUV sales will go through the roof, which is good for U.S. automakers. That's what they make money on. This is a question about the importance of airlines. Once airlines start flying again, how much of a demand will that have with respect to jet fuel and oil generally?
Yeah. So jet fuel has been the biggest hit because what shut down quickest and most completely was air travel. It's about 8% of total oil market consumption. So a relatively smaller segment, much bigger light-duty vehicles, trucks and trains and planes and trucks and planes and then petrochemicals are the bulk of it. So it's a fairly small part. It is stressing the logistical system because you suddenly have to store a lot of jet fuel, and we don't have a lot of storage of jet fuel per se. So it creates certain problems for the storage sector that are acute, sort of outsized to its share of consumption. But, that 8% should bounce back fairly quickly once, because the plane doesn't matter how many people are on the plane. As long as the plane's taking off, it's burning a certain amount of fuel. And if the planes resume, I think you'll see that sector bounce back quite fast.
Wonderful. Another question about the future of OPEC and how durable it is in terms of setting prices. What course of powers do they have, and how can they discipline the system? How do you see OPEC playing out?
Okay. And I'm going to have to play the historian technician a little bit with the semantics. OPEC, the 12-member group that we're all familiar with since the 70s, OPEC is AWOL, has been AWOL for 10 or 15 years. OPEC has been largely irrelevant. What we speak about now is more OPEC plus, right? This is this 23-member group where Russia and 12 OPEC, non-OPEC countries have come together. And it's more than just a semantic and organizational, because it really does get to, it's the Saudi and the Russian alliance. I noticed even President Trump has begun over the last few days to speak about OPEC plus. So I want to be very clear, I'm talking about OPEC plus. OPEC plus is the potential successor to OPEC, which reigned for about 4 decades, as the stabilizer of the market with more or less success. It followed OPEC, the Texas Railroad Commission, which the 4 previous decades was it. So the question is, will this OPEC plus be a new long-lived central bank, to invoke a metaphor that's more familiar perhaps to you and your organization? Will it be the new long-term Federal Reserve? Or will it be a fly-by-night short-term cartel that has popped up in the past and goes away? In my view, it's always been the case, OPEC Plus is going to succeed as long as the problem is oversupply. There may be problems like last month, and they need to get lucky, like President Trump basically removing Iranian exports has really helped keep a floor under prices. Let's be very honest. President Trump probably deserves an OPEC Achievement Award, not just for last weekend, but for having contributed, 2 million barrels a day of Iranian exports. So President Trump has done wonders for OPEC Plus, I should say. But where, Tim, I think OPEC Plus will not succeed is where OPEC failed in 2008 and where the Texas Railroad Commission failed finally in 1972. And that's in the boom phase. Because if you think about it, if you're OPEC Plus, like in March or like right now, you have the option to cut production. Well, you really don't because of the shut-ins. But in normal circumstances, a swing producer group has the options to cut or not cut, right? Because that's a voluntary policy decision. But if you're in a tight market where demand for oil is exceeding the supply growth, inventories are being withdrawn, and your spare capacity, the oil that you hold back to manage the market, is being exhausted, you're increasing production, then you don't have a choice. You're unable to cap prices. This is how we lost it in the late 60s and early 70s. That's what happened to OPEC from 05 to 08. And I think that's what's going to happen to OPEC Plus later in this decade, whether we're at 100 million barrels a day or 95 million barrels a day. I think we're going to see demand explode faster than supply growth. OPEC Plus is going to run out of spare capacity. Prices are going to boom. And in that way, I think OPEC Plus will sort of abdicate, if you will.
So you're bullish long term. I got a question for you. Is there any chance that Texas uses its authority to impose quotas on production? And what do you make of recent reports the U.S. government would pay producers to keep oil in the ground?
Yes, great questions. On Texas Railroad Commission, I would put the chances at about 10 to 15% as we sit here today. I testified, along with many others, at the marathon hearing, if any of you participated or listened to that on Tuesday. My sense is, since OPEC Plus over the weekend acted without requiring Texas to act first, the pressure was off. I think one of the reasons the commissioners might consider quotas is if they thought doing so would leverage or trigger other cuts by other states. And by the way, Oklahoma is going to have a meeting on May 11th, and other countries. So for the time being, I think the pressure's off. I think the commission seemed to be most compelled and impressed with arguments that basically said, look, it's not clear we're going to fill up stocks. The market is working. Let's let OPEC Plus clean this up and so forth. So my sense is the votes aren't there today. However, let's watch the price of oil. They will be having a meeting on April 21st. I think right now votes aren't there. If prices go down further, if the pain goes up, if we get back to another OPEC Plus meeting will be on June 10th. And if there's more of a conditionality, if the other OPEC Plus countries say, look, we're not going to do any more here unless we see some real buy-in from other states, then, the odds might go up. We assess, I don't have a dog in the fight. We're not pro or anti-quotas, but as we call balls and strikes, I would say odds will go up as prices go down, but right now below 50%. Yeah, there was a report yesterday, and it's true, I think, the Department of Energy has been looking into kind of replicating what we do with farmers to say, look, I know you're about to plant that field, but how about we take it out, put it into conservation, let ducks grow and so forth, and don't plant that thing. And let's do it for oil. So pay you not to produce oil you would have produced otherwise. The big problem with that is the House of Representatives, one of the problems, and they would have to approve an appropriation. I think the administration's made it clear to Congress that it understands it could not do this by itself. So you'd have to have Nancy Pelosi agree. Would Nancy Pelosi and the House agree? Probably not. They weren't even willing to give $3 billion to fill up the SPR, or they wanted trade-offs in terms of environmental policies the administration was unable to give. So I think one thing that might entice the Democrats is the idea of keep it in the ground. But there's a difference between keep it in the ground forever and keep it in the ground until prices go higher, in which case the government would sell it and make a profit. So I don't think the Democrats would be too interested in that. So for that reason, I don't think they'd agree on how long to keep it in the ground. And for the need for an appropriation, I think it's less likely you'll see this policy. I think it does show the creative thinking and the desperation in the administration. But I think it's more likely, Tim, Plan B will be some form of tariff. If Plan A doesn't work, Plan A is get Saudi Arabia and Russia to call off their fight, put in place cuts, get the price back to $35 so shale can breathe. If that doesn't work, I think the president's been pretty clear and credible. Tariffs will be next.
Bobby mentioned the SPRO, and the reason that we're not filling it is because of an appropriations issue. The House won't approve the funds to pay for refilling.
Yes, although, yes, but the administration did then announce that it's going to rent space to the private sector. And there it can do that without an appropriation. So it can say to producers, look, we've got 23 million barrels, 30 million barrels available. If you'd like to, park your oil here, you're happy to do so. It's an exchange. You'll have to take it out later, and your payment will be a small payment in terms of volume you'll leave behind for us. So we can do that. It's called an exchange. It's done during storms and things where usually the oil goes out. This time the oil will be coming in. That it can do without Congress. And so I do think we're going to make that storage. About 8%. It's not insignificant. The amount of that 77 million barrels of spare SPRO capacity, about 8% of what's available what's available commercially. I think the administration will find a way to make it available to the market one way or the other. I think we'll also see another debate with Congress about an appropriation to buy it down the road as well.
Another question about the electrification of the U.S. auto fleet. Obviously, the gasoline prices at this level, it undermines, to your point earlier about auto truck sales, it undermines the movement toward electrification. How big of a hit does the electrification movement take?
In the United States, not that big. And here's why. I think the real gains in terms of oil peak demand, if you will, or the consensus believes gasoline demand is about to peak and collapse in this country. That's what EIA shows and IEA does as well. So we're about to see, even before the coronavirus, a permanent peak and collapse in demand. That's mainly not due to electric vehicles. Electric vehicles are a little more of a China story, and there they are collapsing the sales since last year. China is another whole fascinating story. In the United States, it's really about the efficiency of the light-duty fleet. And the reason EIA and others have been forecasting this peak and collapse in gasoline demand the next 5 years in the United States is not so much an EV, it's more the light-duty fleet efficiency. And I could go on all day about that. And, we worked together in the Bush administration, and I was working with President Bush when we reformed the CAFE or fuel economy standards. But long story short, even if President Trump hadn't weakened President Obama's fuel economy regulations, which he just did, but even had he not, the way they've been reformed, I do not think they were tough enough to put that peak and collapse in gasoline demand that EIA and others had been expecting. So I think first of all, we're going to see a delay in terms of the efficiency of cars that people are buying, partly because the regulations were eased, but partly because people are going to have less money. They're going to be more inclined in a $2 gasoline world to buy what they can afford, which is a conventional fueled car. They will be more efficient cars. Efficiency improves every year, but that doesn't mean consumption goes down, right? Consumption is a function of GDP growth and miles traveled and so forth. And so, and even we're seeing with the Ubers and the Lyfts and so forth, social ridership is actually increasing congestion, or it has so far until the coronavirus, because it's making transportation more efficient and less costly and more affordable. And so consumption of transportation is going up. So I do think it dings the story. I think it's more, the EVs is more of a China story than it is the United States, though.
And Bob, what a question about gas, transition to gas as a transition fuel source as we move to a low carbon or zero carbon based economy by mid-century, which is the UN development goals. Are you bullish on gas as a transition fuel source?
You know, I am, but it's going to be rocky. It's going to be difficult because one of the most remarkable transitions in the United States, I think, politically, has been the movement by the Democratic Party from a view that, you know, gas is a bridge to a clean fuel future and a sort of an all the above approach to where gas is the new enemy. And although Joe Biden, now the nominee, is much more in the moderate, let's say, Obama camp, the concerns that gave rise to sort of demonizing gas are not going away. And they are held by especially the younger folks. And it's part of the concern about climate change, which is not going away. And so I think one of the biggest changes in the last few years has been the Democratic Party's hostility to natural gas, which is now viewed as just as bad as coal and oil. So I would be concerned if President Biden is elected. I think there could be resistance to gas, and it's not just gas production, but you need the federal government for pipelines and other things and exports and so forth. You know, the federal government plays a very important role in facilitating a healthy gas sector. And were the federal government to become hostile, or even if it was through the courts or through direct regulation, I think it could put the brakes on gas. So I think gas's biggest problem is not economical. It is just an abundant, superior, low-emission alternative to coal and so forth. It isn't, but it's going to be managing. It's being lumped in with oil and coal in the bad guy box, if you will, with regard to emissions.
Now, you mentioned the politics of fracking. Obviously, the progressive wing of the Democratic Party during this campaign has been anti-fracking. We're here from Elizabeth Warren and Bernie Sanders. If Joe Biden is president, what's your assessment of fracking in 2021 and beyond? And what does that mean for the U.S. Domestic production?
Yeah, well, he is. I think now almost any Democratic president who gets elected now has committed and will have to, on the first day or so, announce a ban on new fracking on federal lands. So 24% of crude production, less than that in terms of natural gas. But it's a pretty big deal in terms of new drilling, new fracking. It looks like the president has authority and will do that. That's not too bad of a deal. The real question would be if the president wanted to really hobble gas and oil production and really fracking. The biggest tool there is exports, because the president can declare an emergency, and President Trump has sort of shown the way here with the liberal use of emergencies. Right, president could declare climate change to be a national emergency, and on that basis announce a suspension or a halt to gas exports, LNG exports, and or crude oil exports, for that matter, products as well. And boy, hard to model. We could be down we did some analysis, and if the president did something like that, we could be down 3 million barrels a day. It could be in a coronavirus plus in terms of what the impact would be on U.S. production if the president chose to use the handiest tool, which is the export valve. You kill those exports, you will kill fracking, and we could be down, from 12 to 9 million barrels a day, ex-coronavirus in terms of crude production, quite fast if the president decided to do so. Will Joe Biden do that? I doubt it. Not where he's coming from. I think it's more likely they will take exports and fracking hostage and threaten it, maybe even suspend it, pending a kind of a workout with the industry. I think the Democrats will try to approach the industry, get some buy-in, and get some sort of agreement on an approach that favors renewable alternative fuels without actually killing exports. I don't think that's in Joe Biden's blood, really, to do that.
I completely agree. Bob, unfortunately, we run out of time. I've thoroughly enjoyed this conversation, as I always enjoy our conversations. I learned so much from you. Thank you for taking time out of your busy day and spending it with me. And I hope you and your family remain safe and healthy. And I look forward to seeing you in person again sometime soon. Thank you, Bob.
Thank you, Tim. It was a pleasure, and have a great conference. Look forward to catching up. Thanks again.
All right. Bye-bye.
Bye-bye.